Most ETF investors do not lose money because ETFs are bad. They lose money because they make one mistake that looks smart at first, but quietly damages their returns for years. They think they are diversified. They think they are being safe. They think more ETFs means more protection. But sometimes, the more ETFs they buy, the more confused, duplicated, and risky their portfolio becomes. And the worst part? Most investors only realize this after the damage is already done. This video is for educational purposes only, not financial advice. Always do your own research before investing. Now imagine two investors. Both live in America. Both have stable jobs. Both want the same thing: a comfortable retirement, more financial freedom, and less stress about money. The first investor keeps it simple. He buys a broad market ETF, maybe one that tracks the S&P 500 or the total US stock market. Every month he invests a little more. No drama, no chasing trends, no panic. Just a clear plan repeated over time. The second investor starts the same way, but then he sees a tech ETF going up, so he buys it. Then an AI ETF, then a semiconductor ETF, then a dividend ETF, then a clean energy ETF, then a growth ETF, then another ETF someone online calls the future of investing. Now he owns 8 or 9 ETFs, and on the outside, it looks impressive. It looks advanced. It looks diversified. But when you look under the hood, something strange appears. Many of those ETFs own the same companies: Apple, Microsoft, Nvidia, Amazon, and Google. Different ETF names, different themes, different marketing, but the same stocks underneath. So he does not really own 8 different investments. He owns the same few giant companies again and again. And when those companies fall, his whole portfolio drops harder than he expected. That is when the painful question comes. Wait, I thought I was diversified. This is the ETF mistake most investors learn too late. They confuse owning more ETFs with owning real diversification. More ETFs can make a portfolio look safer, but sometimes it only makes the risk harder to see. The first lesson is simple. Never judge an ETF by its name. A fund can sound safe. It can sound futuristic. It can sound like a once-in-a-generation opportunity. AI, robotics, crypto, clean energy, electric vehicles. But a good story does not always mean a good investment. Before buying any ETF, ask one basic question. What does this fund actually own? Because if you do not know what is inside the ETF, you do not really know what you own. The second lesson is overlap. This is where many beginners get trapped. They buy an S&P 500 ETF, then they buy a growth ETF, then they buy a tech ETF, then they buy an AI ETF, but many of them may still depend on the same mega-cap stocks. So instead of spreading risk, they are stacking the same risk in different wrappers. It feels like diversification, but it is really duplication. The third lesson is fees. A small fee looks harmless. 0.03%, 0.5%, 0.7%. It does not feel dangerous today, but investing is not a one-week game. It is a 20-year or 30-year game. And over decades, small fees can quietly eat the money that should have been compounding for your future. A tiny fee today can become a silent tax on your retirement tomorrow. The fourth lesson is hype. Most people do not buy hot ETFs because they deeply understand them. They buy because everyone is talking about them. They see videos, they see headlines, they see green charts, and they feel one dangerous emotion: fear of missing out. But here is the truth. By the time a hot ETF is everywhere, the easy money may already be gone. Early investors may already be taking profits while beginners are rushing in. That is not strategy. That is emotional chasing. And this is the mindset shift. A strong portfolio is not supposed to impress people. It is supposed to work. Real wealth is usually built through boring decisions repeated for a long time. Low-cost funds, broad exposure, real diversification, patience, consistency, and a clear reason behind every investment. So, before you buy your next ETF, ask 3 questions. What does this ETF own? Does it overlap with what I already have? And does it support my long-term plan, or am I just chasing excitement? Because the goal is not to own more ETFs. The goal is to own the right ETFs. The mistake most investors learn too late is thinking complicated means smarter. But in investing, simple often beats clever. A clear plan beats hype, patience beats panic, and understanding what you own beats blindly following the crowd. So before you add another ETF to your portfolio, stop and look under the hood. Because one small mistake today can quietly cost you years of returns tomorrow. If this video helped you see ETFs differently, hit like, subscribe, and comment below. How many ETFs are in your portfolio right now?